This is something a lot of people have asked about. And honestly, it took a while to put together, because these are stories Warren Buffett himself doesn't like telling. Everyone knows the wins. Everyone knows the billions. But almost nobody knows how close the whole thing came to falling apart. Not once, but 5 separate times. These are the 5 investments that nearly destroyed the greatest investor who ever lived. And the last one on this list almost didn't just destroy Buffett. It almost took down the entire American financial system with it. Number 5. ConocoPhillips. It was 2007, and oil was on an absolute tear. Prices were climbing past $100 a barrel and showing no signs of stopping. Every analyst on Wall Street was calling for higher. The energy sector was the hottest trade on the planet. And Warren Buffett, a man famous for ignoring what Wall Street says, did something unusual. He listened. He started buying shares of ConocoPhillips, one of the largest oil and gas companies in America. By the end of 2007, he'd put in just over $1 billion. But then, in 2008, as oil kept climbing, Buffett kept buying, and buying, and buying. By the time he was done, Berkshire Hathaway had poured $7 billion into ConocoPhillips. $7 billion. At an average price of about $85 a share. It was the largest publicly traded stock investment of Buffett's entire career. Nearly 15% of Berkshire's entire portfolio was sitting in one oil company. Then the world fell apart. The 2008 financial crisis hit like a freight train. Oil prices didn't just dip, they collapsed. From $150 a barrel to under $40 in a matter of months. ConocoPhillips stock cratered right along with it. Berkshire Hathaway reported a $1.5 billion loss in the first quarter of 2009, the biggest quarterly loss in the company's history, all because of one trade. In his 2008 letter to shareholders, Buffett didn't hide. He opened with this. During 2008, I did some dumb things in investments. He went on to say he bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. He said he in no way anticipated the dramatic fall in energy prices. And then he said something that most billionaires would never admit publicly. The terrible timing of my purchase has cost Berkshire several $1 billion. He sold off 40% of the position almost immediately, and by 2013 had completely exited. The Oracle of Omaha, the man who built his legend on patience and timing, had timed the single biggest trade of his career almost perfectly wrong. Number 4. The airline investments. Here's what makes this one sting. Warren Buffett spent decades publicly warning people to never invest in airlines. He famously joked that a durable competitive advantage in the airline industry was about as real as a unicorn. He called airlines a bottomless pit for investor capital. He once said that if a capitalist had been present at Kitty Hawk when the Wright brothers first flew, the best thing he could have done for his successors was shoot Orville down. That's how much Buffett hated airlines. And then in 2016, he bought all of them. Well, not all of them, but he took significant stakes in the 4 largest airlines in America: Delta, United, American, and Southwest. Billions of dollars spread across the entire industry. The same industry he had spent 30 years telling everyone to avoid. When people asked him what changed, he said the economics of the industry had improved. Fewer competitors, better pricing discipline. He was convinced this time was different. For a few years, it actually looked like he was right. The airlines were making money. The stocks were performing. Buffett's contrarian bet seemed like genius. Then in early 2020, a virus nobody had heard of started spreading from a city in China. Within weeks, global travel ground to a halt. Planes that had been full were now flying empty. Airlines that had been profitable were now burning through millions of dollars a day just to stay alive. Buffett's airline stocks collapsed. And unlike ConocoPhillips, where he held on hoping for a recovery, this time Buffett saw something worse. an industry that might never fully come back to what it was. In April 2020, he sold everything, all 4 positions, at a massive loss, billions of dollars gone. At Berkshire's annual meeting, he told shareholders he had made a mistake. He said the airline business changed in a very major way, and that the world changed for airlines. The man who warned everyone for 30 years about airlines learned his own lesson the hardest way possible. And the cruelest part? Within 2 years of Buffett selling, every single one of those airline stocks recovered and climbed higher than where he sold them. He panic sold at the bottom. Warren Buffett, the man who built his empire on never panic selling, panic sold at the bottom. Number 3. Berkshire Hathaway. This one might surprise you because Berkshire Hathaway is Warren Buffett's company. It's his legacy. It's the vehicle that made him one of the richest people on the planet. And he has said publicly, multiple times, that buying it was one of the worst investment decisions he ever made. In the early 1960s, Berkshire Hathaway was a struggling textile company based in New Bedford, Massachusetts. The industry was dying. Cheap overseas competition was crushing American textile manufacturers. Buffett started buying shares in 1962 because he noticed a pattern. Every time the company closed a mill, the stock would bump up slightly. It was a classic value play. Buy low, wait for the bump. Sell. Nothing fancy. Then in 1964, something happened that changed everything. The owner, Seabury Stanton, offered to buy back Buffett's shares at $11.50 per share. They agreed on the deal verbally. But when the written offer arrived a few weeks later, the price had been lowered to 11 3/8, a difference of 1/8 of a dollar per share. And it made Buffett furious. Not because of the money, because of the principle. A man had given his word and broken it. So instead of selling, Buffett did the opposite. He bought more shares, enough to take control of the entire company. And then he fired Seabury Stanton. It was a revenge purchase. He bought a dying textile company not because it was a good investment, but because he was angry. He later admitted that if he had simply taken that original 11 3/8 offer and put the money into insurance companies directly, which is what he eventually did through Berkshire anyway, the compounding over the following decades would have been worth hundreds of billions of dollars more. He called it a $200 billion lesson in not letting emotion drive your decisions. He nursed the textile business for 20 years, watching it bleed money, before finally shutting it down in 1985. The only reason Berkshire Hathaway became what it is today is because Buffett was smart enough to use it as a holding company for better businesses. But the textile company itself, the thing he bought out of spite, was a disaster from day one. Number 2. Dexter Shoe Company. Buffett himself has called this one his most gruesome mistake, not his worst investment. His most gruesome. And when you hear the numbers, you'll understand why. In 1993, Berkshire Hathaway acquired Dexter Shoe Company, a shoemaker based in Maine. The company was profitable, well-managed, had a terrific track record, and produced 7.5 million pairs of shoes a year in American factories. Buffett loved everything about it. He called it a business jewel. He said it was one of the best managed companies he and Charlie Munger had ever seen. He was so confident in the deal that he reportedly told people he sang, "There's no business like shoe business," as he drove to work. The price was $433 million. But here's where it gets ugly. Buffett didn't pay cash. The seller, Harold Alfond, demanded Berkshire Hathaway stock instead, and Buffett agreed. He handed over 25,203 shares of Berkshire Hathaway Class A stock. At the time, those shares were worth $433 million. Within a few years, Dexter's competitive advantage evaporated. Cheap shoes from overseas flooded the American market. By 1999, 93% of all shoes purchased in the United States were imported. Dexter couldn't compete. The company bled money until there was nothing left. 1,600 workers in a small Maine town lost their jobs. Many past the age where they could learn a new trade. The business Buffett called a jewel went to zero. But the real horror isn't that the company went to zero. It's what he paid for it. Those 25,000 shares of Berkshire stock that were worth $433 million in 1993. They kept growing. And growing. By 2007, they were worth $3.5 billion. By 2020, $12 billion. Today, those same shares would be worth over $14 billion. Buffett gave away 1.6% of the most valuable company in America to buy a business that became completely worthless. In his 2014 shareholder letter, he wrote that the Dexter deal was the most gruesome mistake he'd ever made. He said it deserved a spot in the Guinness Book of World Records as a financial disaster. And unlike most of his mistakes, where only money was lost, this one cost 1,600 people their livelihoods. That's the part he said haunted him most. Number 1. Salomon Brothers. If Dexter Shoe was Buffett's most gruesome financial mistake, then Salomon Brothers was the moment his entire reputation, his company, and arguably the stability of the American financial system nearly collapsed, all on a single Sunday afternoon. In 1987, Berkshire Hathaway invested $700 million in Salomon Brothers, one of the most powerful investment banks on Wall Street. It was a 9% annual dividend on preferred stock with an option to convert. A classic Buffett deal. Downside protection with upside potential. He joined the board, and for a few years, everything was fine. Then, in the summer of 1991, the truth came out. A Salomon bond trader named Paul Moser had been submitting false bids at United States Treasury auctions, essentially trying to corner the market on government bonds. This wasn't some minor rule violation. This was fraud against the United States Treasury. The government securities market was a $2.2 trillion system that the entire global economy depended on. And a trader at the firm, where Buffett was the largest shareholder, had been rigging it. It gets worse. The senior leadership at Salomon, CEO John Gutfreund, President Tom Strauss, and the firm's lawyer Donald Feuerstein had known about the illegal trading for months and failed to report it. When regulators finally found out on their own, the response was swift and devastating. On Sunday, August 18, 1991, a day Buffett later called the most important day of his life, the United States Treasury banned Salomon Brothers from bidding in government securities auctions. For any other company, that might have been survivable. But for Salomon, government bond trading was the lifeblood of the business. The ban meant Salomon would likely have to file for bankruptcy immediately. We're talking about a firm with 8,000 employees, a firm that was counterparty to billions of dollars in trades with banks and institutions around the world. If Salomon collapsed, the dominoes would start falling across the entire financial system. Buffett, who had stepped in as interim chairman just days earlier, after forcing Gutfreund to resign, spent those hours on the phone with Treasury Secretary Nicholas Brady, desperately trying to get the ban reversed. He later described it as 4 hours of pure terror. 4 hours where a $9 billion firm, and everything connected to it, sat on the edge of total destruction. The Treasury relented. They modified the ban to allow Salomon to continue trading for its own account, effectively keeping the firm alive. But the damage was enormous. Salomon was fined $290 million. Clients fled. Lawsuits piled up. The firm's reputation was in ruins. Buffett then had to go before Congress and testify. He sat in front of the cameras and the committee, and he apologized. He told them that the past actions of Salomon were causing 8,000 employees and their families to bear a stain they didn't deserve. And then he delivered the line that would define his philosophy forever. He told every Salomon employee to be their own compliance officer. He told them to ask whether they'd be willing to have any action they took appear on the front page of their local newspaper the next day, to be read by their spouses, their children, and their friends. And then he said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." He spent 9 grueling months cleaning up the mess. He later wrote that it was the only time in his life he had trouble sleeping. When he finally returned to Berkshire full-time, all he said was that the Solomon Post, though far from fun, was interesting and worthwhile. That's it. A man who usually can't stop talking about his investments reduced the worst experience of his career to one line. That tells you everything about how close it came. 5 investments. Billions lost. A company bought out of spite. A shoe company that destroyed a town. An oil bet at the worst possible moment. An airline gamble that contradicted everything he ever taught. And a Wall Street scandal that came within 4 hours of bringing down the entire system. Warren Buffett survived all of it. Not because he was lucky, because he did something most men refuse to do. He admitted he was wrong. In public, in writing, in front of Congress. He owned every single mistake, learned from each one, and kept building. That's the part of the Buffett story nobody tells. Not the wins, the near destruction, and what he did after. Because the real measure of a man isn't whether he falls. It's what he does when his face is in the dirt and the whole world is watching.